Google is still the cheapest tech company to buy now with its forward P of 21.28 when we compare this to some of its competitors like Microsoft, whose P is astronomically high at 35, and even Apple, who they talk about having a lot of low growth for the future, its PE coming in at 28. So why is Google's PE so low? What does the market see that maybe the investor doesn't see? And is it a strong undervalued buy now? We're going to find out in today's episode, and we're going to start off by taking a look at how Google brings in revenue, how it's generated. Now, this is essentially from a few months ago, in fact, from the end of 31st of March 23, but a lot of the percentages still holds true. What's important to understand is that their search advertising brings in nearly 60% of their total revenues, making up more than half, with their next being the AdSense and YouTube. One of the reasons that we see the company trading low on the PE is that investors are worried that their search advertising income will be attacked heavily by Microsoft's ChatGPT taking over the search engine. Essentially, now what you have to understand is that even after a few years of ChatGPT being available and Google still there being its normal self, we can see that Google still maintains clear advantages around 90% of total searches. So in reality, whilst there is that worry with ChatGPT, Google still is the king in search engines. And what we can also see is that one of the worries that the market has is that management is very, very poor. One of these aspects are here now due to the stock-based compensation that we can see year on year seems to be increasing at a very rapid rate, nearly 10% of their total revenues that we will run through shortly. In 2023, they paid $22.46 billion in share-based compensation, and we can see it is increasing in double digits every single year over the last 10 years. So this is a bit of the worry that the market has, not just on the management, but the high cost that the share-based compensation is taking from total revenues. Now, one thing to note that if you weren't aware of that Google have been doing, and we'll take a look at this as part of our financial metrics, is that they have been buying a lot of shares back from the company, which is very good to note because it returns excess cash to investor pockets. In Q4, in their latest accounts, they revealed they bought back 61.5 billion worth of shares, which is essentially a near 4% increase from the previous year. So that is very positive. We will touch upon that as well, but we can also see here what we just mentioned in terms of their high stock-based compensation, around 22.5 billion. So let's take a look at some of the numbers now. Typically on the channel, what we like to see on the top line is around 3 to 7% growth year on year. Although with these tech companies, we do understand it will be at a much rapid rate. December 2019, now 162 billion reported on their top line. December 2023, their latest annual report, 307 billion. So it is nice to know not only has their top line nearly doubled over the last 5 years, but at a very rapid rate that it is increasing. And we will shortly look at the last 10 years in percentage form. Now, when we take a look at essentially their bottom line as well, 34 billion in 2019, 74 billion in 2023. So it has more than doubled over the period. But one thing that we do note here that we haven't seen on the top line is the inconsistencies. 2019, it did increase all the way to 2021 before decreasing and then picking back up. But we can see even picking back up, 2023's bottom line is still lower than 2021's. Nonetheless, both top line and bottom line have been increasing over the last 5 years. Now, when we do a quick health check of the company, total cash versus total debt, 120 billion reported on their cash balance sheet, but we can see in their latest quarterly report, it has dropped, although very slightly. They still hold a very, very large amount on there of 111 billion. Now, when we compare that to their total debt numerically and directionally, what we can see is that it has increased from 16 billion to 30 billion. So yes, their total cash has decreased slightly and their total debt has increased. It isn't what we like to see, but they still hold a far significant amount of cash than they do total debt. So no worries there, and we will touch upon some of their metrics, including the net debt to EBITDA. Very quickly then, looking at their total return versus others in the interactive media and services, we have Meta Platforms, Tencent Holdings, and a few others that are well known. We can see that Google, their total return of 58% over the last 12 months, is in fact the second best, just second to Meta, which had an incredible run over the last few weeks. When we extend this to the last 5 years, we actually see Google looking very, very strong. In fact, the best performing over the last 5 years, outperforming Meta's 142%. But what's important to understand with this, just because they had a very strong run over the last 5 years, past performance isn't an indicator of future. Now, very quickly, we have run them through the insider screening for management buyers and sells. We've looked at both buyers and sells in the transactions, minimum 100 shares. And even when we've extended it over the last year, there is nothing to report in terms of buying and selling. In terms of institutional ownership, well, it sits at 27%. 42 billion worth of sales by these institutions over the last 12 months. But what we note here is a little bit more buying, 54 over the same period. So institutions, they are buying a little bit more than they are selling, but realistically, it isn't that much of a large gap as we do see on this channel. But one thing we do want to note, in Q1, there was more selling than buying. Q2, we see the opposite, and then in Q3, again, we see the opposite. And in the latest quarter, we see a little bit more buying, 11 billion versus 7.64 selling. So it looks very, very inconsistent. Institutions are always changing their minds quarter on quarter, although we do note not only the latest quarter, but overall over the last 12 months, institutions are buying a little bit more than they are selling. But as always, do your own due diligence and never solely rely on the institutions. So let's take a look at some of these financial metrics. Now, firstly, we'll start off with the free cash flow per share. Typically, the earnings data isn't something I take a look at due to the fact that it is susceptible to manipulation by management through their accounting. So free cash flow, very nice to see the increase, 89 cents in 2014, 5.50 in 2023, expected to go even higher in 2024 at 6.17. So very strong growth. Yes, it isn't very consistent. We do some years, in fact, a decrease from 2016 to 2018, and we do see that again in 21 to 22. But over the longer term, if you are a shareholder of Google, it does look like a very strong performance. In terms of sales growth, now, as we always like to see 3 to 7% for these tech companies, it isn't uncommon to see double-digit growth, which we see here with Google. 2021, a very large astronomical year. One thing we would say, it does look like over the longer term, the top line has been slowing down. Nonetheless, 10%, 9%, very, very strong, and it could go back to those very high levels that we have seen over the last 10 years. Numerically, though, very, very strong, 66 billion in 2014 to 307 in 2023. As we mentioned earlier, the shares outstanding, they did do a lot of share buybacks over the last few years that we can see here as well. Although we do note they also did share issuances over the last 10 years, but the net position is share buybacks from 13.7 billion to 12.7. So they bought back essentially over the last 10 years 1 billion shares, which is very strong. Nice to note that from this company. But one thing that we would say is they have issued equity before, so it could be common for them to do it again in the future. Not saying that it will, but typically for companies that we have seen that do it in the past, if they do want to do it in the future, it is something that we have seen. Talking about shares outstanding and share buybacks, we have done our latest free weekly article talking about share buybacks running through companies that have bought a lot of shares, adding a lot of value to investors, alongside other articles if you are interested, completely free. Just by clicking on the pinned comment below, you have access to all of this. ROIC then, it's nice to note it has been increasing over the last 10 years. Personally, I like to see 10% or more as it gives me faith that management are able to effectively allocate their capital. Going from 15% to 28%, very strong, and even the last 3 years in the high 20s is a very nice indicator that I personally like to see as an investor. Operating margin, pretty consistent over the longer term in the mid to high 20s, so that is nice to note. 29% in the latest year, very positive. And free cash flow margin, again, pretty much a similar story. Consistency around the high teens to the low 20s, 23% in 2023. Finally, the net debt to EBITDA. Now, this typically shows us the balance sheet strength, the earnings before interest, tax, depreciation, amortization, and shows us the number of years it would take the company to pay off all of their debt net of cash on hand. This essentially says it wouldn't even take them 1 day, so a very, very strong balance sheet, as we did run through earlier. So let's jump through the valuation model for Google, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Starting with the first model today, then we have the multiples valuation model. Companies in a similar sector and size, we have their PE multiples, the average PE multiplied by that of Google to get an intrinsic value of $189. So we have our first signal of undervaluation, although do bear in mind we're not looking at any of these models in isolation. We then have the DCF model with the free cash flow year on year. Now the average growth rate moving is 23%, although we have gone for a much lower forward looking of 10% and lower than analyst estimates. With our discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have an intrinsic value again, showing undervaluation with the intrinsic value above the market price. So the intrinsic value here today is just the average of these two models that we have gone through for Alphabet, and it comes to $176. Now, for those that are interested, you can grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio by clicking on that pinned comment below. Now, typically, we start off with a margin of safety of 10% if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10% margin of safety, it would be a buy up to $158, and we keep going towards the current trading value. At 15%, a buy up to $149, at 20% around $140, so it isn't quite there yet. So we've seen between a 15 to 20% MOS level based on our estimates and judgments. In terms of Wall Street and what they forecast, well, they have a price target over the next 12 months of $165 with upside of 15%. So they do see Alphabet right now as a fairly strong buy. Now, personally, this isn't one that I hold directly. However, through the ETFs that I hold, Google is a fair enough portion. So for me right now, based on the current value, I am happy just to hold. However, if we do see this share price come down with a much larger margin of safety, around 25 to 30%, then it is one I may add individually rather than through the ETFs. As always though, do let me know your thoughts in the comments below. Do you believe that Google right now is a very strong buy, or are you waiting for a lower price, or maybe just looking for alternatives? As always, have a great day. If you enjoyed today's episode, smash that like button, and I'll see you all on the next one.